Hey there, this is Pat Ennis of Ennis Legacy Partners. Welcome to the Exit Readiness podcast. I'm here with co-host Walter Dial, CPA and tax partner at GRF CPAs and Advisors in Bethesda, Maryland. We also have with us today my business partner from Ennis Legacy Partners, Corby McGordon. Our mission here on the podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building transferable or sellable business value, and for planning your eventual exit from the business. We want to help you build a business that is transferable or sellable and then exit successfully on your own terms and conditions. When it comes to which exit route an owner chooses, sale to third party, sale to co-owners or key employees, transfer to family members, children, an ESOP, or even liquidation, we are agnostic as to how we approach the work that we do for clients. We simply want to help clients pick and plan for the exit route that is going to be ideal and best for accomplishing all of their goals. Most clients we work with are planning for a sale or transfer to insiders or co-owners or children, family members. But for those who end up selling to a third party, there's almost always what is called an earnout as part of the sale agreement. Earnout provisions generally happen when buyers and sellers have different views on the value of the business being sold and being acquired. Earnouts can help bridge the valuation gap, if there is one, and help in getting the deal facilitated or getting it done. Typically, earnout clauses provide that the buyer will pay the seller an additional amount only if the business achieves specific financial, operational or operational metrics by an agreed upon date after the close of the sale. For example, 10%, perhaps 10% of the purchase price might be contingent on whether an acquired company meets a specific revenue or earnings target over a 2-year period. Well, as much to do with planning for your eventual exit, there are tax implications with earnouts that you should be aware of if you indeed choose a third-party sale. And so that's the topic for today's conversation: tax considerations of earnouts when buying or selling a business. And today's expert is Walter. And you know what? I'm going to do a proper intro of Walter like we would do for any of our subject matter expert guests.
Wow.
Walter is one of these people. He has more letters behind his name than he has in his name. Mr. Dial, and this will be the last time I refer to you as Mr. Dial, as in this introduction, by the way. Mr. Dial provides tax preparation and planning, business valuation, forensic analysis, and exit planning consulting to the firm's clients, GRF, CPAs, and advisors clients, including individuals, government contractors, international financial holding companies, wholesale distribution companies, retail stores, professional practices, consulting firms, and partnerships owning real property. Wow. He and his team are skilled at addressing particularly complex tax issues, and this is true. He does this all the time, with clients concerning investments, estate, and gift taxes, as well as consulting for mergers and acquisitions, liquidations and reorgs, divorce settlements and litigation, public offerings, and buy-sell agreements. A senior tax partner and former director of the firm's tax division, Mr. Dial provides in-house computerized preparation of individual, corporate, partnership, estate and trust, and nonprofit tax filings. He holds the designation of accredited in business valuation, ABV, by the AICPA, as well as the CEXP designation from the Business Enterprise Institute, and a certified exit planning advisor designation by the Exit Planning Institute. And of course, he's a CPA. So, Mr. Dial, welcome to the podcast.
Thank you. Nice to see
As
everybody.
a subject matter expert.
Thank you.
Yeah, you're welcome. And so let's just get started. I'll get us started, Cor, with the first question. So we talk about tax planning a lot on this podcast, and never is it more important than when you're about to do, when you're doing a third party sale and there is indeed an earnout situation. You really need to know and be aware of how you're going to be impacted from a tax perspective. So, Walter, depending on how a deal is structured, earnouts can be treated in a couple of different ways, right?
Yeah.
And if that's right, can you describe each of those ways for us?
Yeah. I mean, most common is a situation where the earnout is just additional sales proceeds. So, kind of going back to what you were saying in your opening, Pat, let's say I have a company that I believe is worth 1.2 million. The buyer believes it's worth $1 million. And there's one big contract that, the buyer kind of thinks, well, we're not so sure that guy's going to stick with us. And I'm convinced they are. So one resolution in that situation would be to say, okay, well, pay me $1 million. And if that client sticks around for say the next 2 years, you're going to pay me $100,000 each year. So I'll get up to my 1.2, and you're okay doing that because the client stuck around. So you agreed 1.2 is a fair price. Mm-hmm. And in that situation, normally all you're looking at is you've just stretched out your sales proceeds. And in that situation, the earnout is going to be considered additional capital gains, which is beneficial.
So it's part of the purchase price in that situation?
Yes. Mm-hmm. Yeah. Mm-hmm. Mm-hmm. You can have a situation where, but it's rare, but you can have a situation where the earnout is instead structured more like some type of compensation. Usually when you have a sale of a company, you have the sale transaction, and then you have maybe an employment contract for the person to stay on, or maybe you have a non-compete agreement where you're paying the person not to compete with you. Those are both pretty common. Both of those would be ordinary income to the seller. He's just receiving basically compensation. So that's income right away to the seller, and it's a deduction when paid by the buyer. Mm-hmm. That's usually what you see. Now, it is possible to take your earnout, and even though it's quote unquote an earnout, everybody kind of understands it's really more of a payment for continuing services or a non-compete. And in that case, it would be ordinary. It would be an ordinary income to the seller and deduction to the buyer. The only reason you would do that from the buyer's perspective is if it's some type of compensation, the payment is going to be deductible right away when he pays it. If instead it's part of the sales price, it's most likely just going to be amortized over 15 years. So it kind of gets back, to the whole, we've talked about in the past, an asset sale versus a stock sale and the pros and cons of that. We should probably do another session on that at some point. But the general rule is if a seller wants to get capital gains, the buyer is going to be stuck with amortizing the cost. Mm-hmm. If the seller is willing to take ordinary income, the buyer is probably going to get an immediate tax deduction. So, the buyer and the seller run the numbers, and depending on tax brackets and tax attributes and things like that, they work out what's best for the two parties.
Mm-hmm. Mm-hmm. Yeah. So, Walter, we became aware, recently of a court case even where the documentation of even a buy-sell agreement had significant impact on tax implications. In this scenario where there's that 200K difference in sale price between the buyer and seller, how would you actually structure an agreement to ensure that it was capital gains for the seller? And how would you do that?
It really isn't that difficult. So the sale agreement, one of the portions of the sale agreement lays out, this is the consideration we're paying for the company.
Mhm.
So it very clearly would lay out, in my example, we're paying you $1 million. And if the following conditions are met, we're paying you 100,000 in year one and 100,000 in year two. Where you can run into a problem is, let's say you've set all that up, and the seller continues to provide services, but there's no compensation for that. Then you might have a problem, because the IRS might come in and say, well, this guy's providing services, you're not paying him, so we're thinking that earnout is really compensation, just disguised. So if you're in a situation where you have an earnout and then you have a clearly spelled out either non-compete or employment agreement, then you're good, because you've papered everything. The IRS can't come in and say, well, this earnout is really compensation, because you've handled the compensation piece, as long as it's reasonable comp. Meaning that, you don't want to have a situation where the guy's going to stay on for 1,000 hours a year and you're paying him $5,000, something like that. That'd be unreasonable. So as long as you paper everything, the IRS looks at these deals and they look at it as if, you've got two parties negotiating and they're at odds, because the buyer wants capital gain, the seller wants ordinary immediate deduction. So the IRS, generally speaking, is gonna honor what the parties agree to. And there's a form that each party to the transaction files with their tax return in the year of sale that says, this is what we have agreed to. And it'll spell out if there's a non-compete or an employment agreement, and the sales price. And they both have to, report consistent with that.
Yeah.
Is that Form 8594?
It is.
Yeah. And that Form 8594 is a good form, is it not, to have if you're considering a third-party sale as a potential exit route, would it be wise for, like, if you have a client, you're going to do an analysis using that form prior to sale, just to give them a good idea as to what would be capital gains and what would be ordinary income tax?
Yeah, for sure. Because I've had a couple transactions recently involving cash basis partnerships. And what sellers often don't realize is that even if they sell their LLC interest, they go, well, I'm selling my LLC interest, it should all be capital gain. But in the partnership setting, for a cash basis partnership, if it has receivables, those are what the IRS calls hot assets. And you'll realize that as ordinary income, even if you sell your LLC interest. So we've had a couple situations dealing with that. And again, it's the kind of thing that if you know it going in, you deal with it. What you don't want to have happen is you think everything's capital gain, you get ready to do your tax return and your preparer says, hey, guess what? Half of what we thought was capital gain is really ordinary income. So, that goes back to what you always say, Pat. It's important that your professionals, be it the CPA or the lawyers, that they're familiar with these types of transactions, because there are nuances that if the professional isn't dealing with it on a regular basis, they very likely may miss.
Walter, in your article, you also allude to timing issues, just in the installment method, and just talk about how structuring even the timing of payouts affects taxation.
Yeah. So when you have a capital gain transaction where you're going to receive a payment in more than one calendar year, you can elect to report your transaction on what they call the installment method. So let's say, a lot of our clients, especially if it's a sale to insiders, they'll have to take back a note. So let's say you sell your company for $1 million, but worst case scenario, it's all a note, and you're not going to start collections till the next year. Theoretically, that sale, absent the installment rules, you'd have $1 million gain in year one. So here you have $1 million gain, possibly a $400,000 tax liability, and you don't have any cash yet. So what the IRS does, or I guess what Congress did, was in that situation, they allow you to record your gain as you receive payments on the note. So your gain follows your cash. So it's a great system. Generally speaking, if you have the opportunity to do that, you pretty much always do it. The only times when you don't would be, let's say you have a large capital loss carryover that you can use, so maybe you don't care. The other times we've foregone the installment reporting is, over the last few years, capital gains rates have gone up and down. So you don't want to elect installment sale and find yourself paying tax down the road when capital gains rates have gone up a lot. So that's really the only other consideration. But generally speaking, if you have a capital gain opportunity to report on an installment basis, you do it. Ordinary income, on the other hand, is not, you don't have an installment option. So the year that you earn ordinary income, you got to pay tax on it.
Yeah, that makes sense. That makes sense. And then you also allude to the fact that when the maximum possible price can be determined, the sale will generally be treated as if it, and you go on and on and on, but then you allude to it cannot be determined. What's the difference? When can you actually determine a maximum possible price, and when can you not?
It's pretty well, let me give you an example. So in the earnout example that we've been giving, where we said, okay, we're going to sell for $1 million and you could potentially get 1.2 million. So you know your maximum. 1.2 is your maximum. And what you do is you calculate your installments sale based on receiving that maximum. And then in the final year, if you don't, you get to make an adjustment to kind of make up for that. And maybe I don't want to confuse people, but maybe it would be helpful just to discuss how an installment sale works. And I'll use real easy numbers. Let's say you're selling your company for $1 million, and your cost basis is 500,000. So you have a 50% gain, meaning on that million, 500,000 is gain. So if you spread that million out, every collection, you're going to record 50% as gain. So by the time you've collected your $1 million, you will have reported 500,000 of gain. So that's the easy way to look at an installment sale. In the situation where you have an earnout, you don't know for sure you're going to get the 1.2, but that's what you assume. And then in the last year, you make an adjustment downward if you don't. Where you can run into a problem is, let's say instead of my easy example, let's say you say, okay, well, I'm going to give you $1 million, plus I'll give you 20% of what we end up collecting from this client. Then it's a little more questionable. We still try to put a maximum on it, because at the end of the day, you're going to adjust it and it's all going to work out. And that's a lot simpler than going through the other method when you can't really figure out what the maximum is. So most of our, most deals, you can kind of figure it out, because even on those formula deals, oftentimes they put a cap on how much they're going to give you.
Yeah, and what I hear you saying is it really is the buyer and seller coming to an agreement to define that number, based upon future potential, rather than a valuation expert actually saying, okay, well, this is what the maximum value will be.
Right. Yeah. You don't have to spend a bunch of money and go through a bunch of crazy stuff to come up with that. The other issue is, like you mentioned, is if you have an indefinite time period, and where that can happen is, again, this is very relevant for sales to insiders, but oftentimes, especially sale to insider, you might put a cap on the percentage of cash flow that can go to pay the owner note.
Mm-hmm.
So if the company does poorly, a 5-year note could end up being an 8-year note.
Yeah.
Because you're stretching those payments out. Again, in that case, we'll often assume that it's not going to get stretched out. And if it does end up getting stretched out, you just adjust the installment sale as you go.
Mm-hmm. Mm-hmm. Yeah.
Yeah,
So-
let me interject something here real quick. We've been talking about installment sales here for the last number of minutes. And of course, there's risk in installment sales of not getting paid.
Yep.
And we did a podcast with Steve Pilger a month or two ago, structured installment sales. We won't get into it now, listeners, but
Hey, Pat,
yeah,
you want to hear something funny about that?
yeah.
Maybe the IRS was watching our podcast, because right after that podcast, they floated a paper wanting comments on making structured installment sales what they call a listed transaction.
Really?
Yeah. So if listeners should go back and listen to that podcast, because structured installment sales are great, but like anything that's great from a tax standpoint, the IRS hates it. And when they hate something but they can't get rid of it, they make it what they call a listed transaction, which basically says, fine, you can do it, but you're going to attach a form to your return spelling out all the details and basically saying, audit me. And that's what they're proposing to do, a structured transaction.
Okay, so
we'll
there's an update for you, listeners, on structured installment sales. Go listen to the podcast, but make sure to get the right advisors involved, who have the current and most up-to-date intel on what the IRS is thinking.
Yeah, but our the basic installment sales are still fine, which is what we've been talking about. The other trap, Pat, for the parties in a transaction like this, when you add some type of compensation piece to the end, you have to be careful, because you can't just all of a sudden say at the last minute say, hey, guess what? We're going to throw in a deferred comp component. There's lots of crazy rules. We've done podcasts on deferred comp too. There's lots of what I would consider crazy rules, which is section 409A of the code, describing what and what isn't deferred comp, and there's substantial penalties if you violate that. So you need to be careful. You can't just toss in a comp piece at the end and not really think about it.
Mm-hmm.
Mm-hmm. Mm-hmm.
I mean, there's something called golden parachute problems too, but that's generally a publicly traded company issue. It's pretty easy to get around for the closely held company.
Mm-hmm. Mm-hmm.
So,
Yes,
are there any other factors that you haven't mentioned that can indicate whether an earnout is part of the purchase price? You were talking about this earlier. I just want to make sure we're thorough here. So any other factors that can indicate whether an earnout is part of the purchase price or compensation for the seller services, or do you think you covered that pretty thoroughly?
Well, let me just make one additional point about that, because there's different tests, but they're really not they're not as important in this setting. Because like we talked about, generally when you sell your company, you got the two parties, they're at odds. You're going to come up with an agreement as long as you do as long as you paper it and you're not, literally trying to evade taxes, you're probably going to be okay. The other area you do see this though is if you have a C corp selling. So if a C corp sells its assets, as we've talked about in other shows, there's the potential for double tax. So oftentimes what will happen is the person who's selling the company will say, look, I'm going to sell you my company's worth $1 million. Well, we're going to pretend it's worth 500,000, and I'm going to sell you my assets for 500,000. Then you're going to give me a non-compete or some type of compensation agreement for the other 500,000, because that would go to him. That would go to the seller directly and would avoid the double tax. That's what the IRS doesn't like, because you're basically disguising a sale that would be amortizable for the buyer, and you're disguising that as immediately deductible for the buyer, plus you've made it only subject to one level of tax for the seller. So that's where you come into things like the IRS says, okay, well, you've got this non-compete, you're already 95 years old. Is it realistic that they're going to pay you $500,000 not to compete with them for 2 years or 5 years? Or while you were employed there, you were making $100,000 a year. Well, gee, they've hired you on at $250,000 a year, and you only have to show up once a week. So it all comes down to reasonableness of the agreements. But again, that's more in the situation I just described than it is in the earnout issues. But it can come up with earnouts also.
Mm-hmm. Walter, you mentioned one other term in passing, as long as you paper it. How would you advise owners then to work with both CPAs and lawyers to make sure they get this right and things don't come into question after the fact?
Yeah. So the first point would be you want an attorney who is familiar with deals, and that is it's a specialized area of law. So you've got a good buddy who's a divorce lawyer. That's not the person you want doing your transaction paperwork. Depending on the sophistication of the attorney, you may need to get an employment lawyer too. A lot of the lawyers that we work with, they've got an employment attorney in their shop who can do that, who can handle that part of it. But generally speaking, on a deal where you're selling your company and you have some type of continuing comp, you're going to need both those types of attorneys to really be safe.
Mm-hmm. Mm-hmm. Yeah.
And I think our role as the exit planner and me as the CPA is always just to make them aware of, you need to get the right people putting these things in place. We don't do that, obviously.
Excellent. Yeah, and that was thought going through my head that the implications are large and it's complex. So there's a penny wise, pound foolishess, approach that won't serve someone in the long run.
Exactly.
Yeah.
Yeah, it's the old, it's really foolish to try to save money on legal fees in a transaction like this, because the consequences of doing something wrong can be gigantic.
Yeah. Good. Makes sense.
Is that your last word?
That's my final word. Hey, can I say one little story?
Yeah.
So my very impressive resume that you read.
Yeah.
Remember how you said I have valued international financial holding companies, I think it was described as?
Yeah, right. Yeah.
So let me tell you the story behind that one. So over 30 years ago, I had just been certified as a valuation expert. And very, very tragically, a client of mine's son had moved to Africa and had set up in, at the time, I think these countries don't even exist anymore, because the African countries have changed their names, but it was 4 different African countries, and not like South Africa, but more like Swaziland and places like that. And he had set up a banking company in one, some type of fintech company in another, and some type of credit card processing company in another. And his whole thing was he wanted to bring, and he came from Goldman Sachs or something. He wanted to bring banking to these unserved, poor African countries. Well, tragically, only being over there for a couple of years, he died in an automobile accident.
Oh.
So our client contacted one of the big 4 and said, hey, I need this company valued for the estate return. And they're like, okay, well, it's going to cost you $100,000, because obviously it was an incredibly complex valuation, right? So me being, 35 years ago, I was even more of an idiot than I am now. He contacts me and says, hey, you want to do a valuation for me? And I'm like, he goes, how much will you charge me? And I said, $10,000. And he goes, okay, it's yours.
Yeah. Done.
So So that's the valuation I did, and it was
Oh, man.
about a 600-page valuation, of which 500 pages were like describing the country and their hyperinflation. And at the end of the day, it came with a very small valuation. And I was just thinking, the estate isn't taxable. The IRS isn't going to spend a bunch of time on this. So I didn't feel bad about it, but it was just kind of funny. So it makes the resume look good, but I wouldn't say that I was hired by Goldman Sachs to, value the largest investment company in Dubai or something.
That's great.
All right. Well, we ask all of our guests if there's anything that they want to promote.
There really isn't, other than I would just say, we're really trying to, in working with Pat and Corby, we're really trying to grow the part of our practice that's not so compliance oriented. So, the exit planning, Corby works with some of our clients on the whole, really keeping track of your finances and growing the value of your company. And Pat does too, as far as the exit planning piece. So, we love this collaboration between the three of us, and we're really, really hoping it will grow. So I would just encourage readers who are looking to grow the value of their business or explore potential succession opportunities to reach out.
Okay, good. So great job, Walter.
Thanks.
Listeners, if you want help maximizing the value of your business or planning for your eventual exit, you can reach Walter at 301-951-9090 and Corby and myself at 301-859-0860. And also Corby mentioned the article that we were using as content for this, that Walter wrote. You can access that article with the same title on the GRF CPA's website, Tax Considerations of Earnouts When Buying or Selling a Business. So thanks for tuning in. If you've liked this podcast, please like it and share it. And we appreciate you tuning in. And until next time on the Exit Readiness podcast, this is Pat Ennis and Walter Dial signing off.